The markets could not have asked for a better election verdict, a clear mandate for the government which doesn't need to fall back on allies, and a prime minister who's looked upon as being business and investor friendly across the world. So does it take care of all the worries, or are there concerns surrounding liquidity or the growth slowdown is going to haunt investors? Let's ask all these questions to N Jayakumar, Managing Director at Prime Securities. Thanks so very much for joining us, Jakes. Just want to start off with, your own outlook on what the future holds now that the election overhang is out of the way. The government is taking center stage yet again, but from a short-term perspective, is there enough ammunition left, enough headroom left from a budgetary point of view, from a fiscal headroom point of view, for the government to actually tackle all the issues that were earlier on highlighted?
Thank you for having me over on your show. I think I would like to, try and see if I can put across a few points that haven't already been sort of covered by your array of guests, over the last couple of days. So just, try to bring out a few points, maybe which haven't been covered. But if you really look at the success of the elections from a BJP perspective, I think you'll realize that they've addressed, or they are addressing, what I would call, the most fundamental needs that India as a polity is aspiring for. If you go back to good old psychology, or rather sociology, which talks about Maslow's hierarchy of needs. So the entire thing about motivation and, self-actualization come much later, but more importantly are the physiological needs of what we otherwise call roti, kapda, makan. In the context of the elections, it meant basically things like electricity, LPG, the DBT reaching the right destination, toilets, etc., etc. So I think what has got them here, the BJP here, and this kind of a mandate, will, I think, see an extension of that, which means a lot more to do with improving infrastructure at the rural level, both in terms of the physical infrastructure. This is now part of their manifesto as well, and the digital infrastructure in terms of high-speed connectivity down to village levels, etc. So I think there's going to be a massive, massive impetus given to developing infrastructure. While we in the cities and, we talk about capital markets, etc., that comes much later. So from a government perspective, I think their imperatives haven't changed. I think it'll be a push on roads. So once your basic roti, kapda, makan is addressed, you will talk about roads, travel, bridges, highways, connectivity of villages to cities, etc., etc. I think that's going to be the order of the day. So from a stock picker's perspective, and I know that that's as much an important aspect of your coverage, people, I think, need to focus on this space. A massive push for rural, digital and physical infrastructure. Coupled with this will be the cleaning up process that's all along been going on. So I would say, for instance, the re-establishing of PSU banks as a fabulous investment destination. Now that most of them have pretty much come down in holding levels to close to the 50-60 range, there's not too much more dilution in many of them, and they have cleaned their portfolios also adequately. So I think PSU banks with very little scope for dilution going forward, being a good equity play. Infrastructure companies very selective. I think consumption, etc., I think will be on the back burner. Some of the really expensive places to hide will, I think, come off. And from that perspective, I think the movement of the index will get replaced with the broad-based market move. And that's the way I think people will make money. A lot more deep dive study rather than pick darts and sort of invest anywhere. I think the other big theme is going to be consolidation, both in terms of smaller PSU banks into the larger ones. And the most important thing, going up the value chain in terms of where the issues are, the NBFC stress that exists today. And the NBFCs have been, as you're well aware, the backbone of financing consumption, backbone for financing SMEs, backbone for financing a whole host of real estate. Today, virtually that funding has come to a grinding halt. And that would need to be fixed with some extra dollops of money, as it were, in terms of this space getting liquidity. Otherwise, you're going to have the problems of the consumption and suffering, and GDP lagging behind estimates. So I think this really is a combination of imperatives and steps, I think, which the government will look to take over not just the next 100 days, but I think virtually over the next 2 years.
While I take your point about infrastructure being a critical focal point for the government, but if you were to look at Modi 1.0, expectations ran high even at that time. But if you translate what infrastructure as a pocket did for equity market investors, it wasn't really a whole lot much. Just a 13% return over the last 5 years, 13 to 18% return over the last 5 years. What do you think is going to dramatically change for this sector from an equity market standpoint, since you're saying that this is probably the next space to invest in?
See, the point here is I don't think the index is the place that you need to focus on or you can use as a parameter, because I think the index even today is largely driven by a handful of 6 to 8 stocks. I think the broader market is trading at least at a 30% discount to the optical index that we see at 11,007 or 11,800. So a broader market move with a lot of small stocks which are in areas that we talk about, I think is the way forward. It's not going to be easy. I think stock picking will become extremely more difficult, because I think there's going to be dramatic consolidation. I think you need to look at companies that are probably in the mid-cap space, not as dramatically leveraged. So the leveraged plays other than in infrastructure would need to probably be avoided, because there's going to be, access to credit is a big challenge in the short run. And unless that can be actually diluted in terms of either standards of lending, which is not going to happen, or in terms of just literally by mandate or diktat coming out and, banks coming out and lending across the board, I don't see companies as a whole getting money. So the real challenge is going to be for access to credit, which therefore links up with formation of private capital or private sector investments, is going to be another challenge. And linked to that, of course, is joblessness. So the government will have to be on the front foot on this in terms of driving infrastructure, driving a whole bunch of these, as I said, whether it's affordable housing or it's roads, bridges, etc. These are two activities that dramatically enhance or drive job creation. And that's the one way that you can offset the lack of private sector capital formation, which is really the stark reality today.
Yeah. You said you're going to put the consumption issue on the back burner. So far, this particular pocket, we've actually seen the higher Ps being offset by healthy EPS growth. But that has changed in the recent past with the consumption slowdown. Is that a temporary blip according to you? And one should look past that, in hopes of this normalizing?
I'm not a great fan right now for investing in many of these high P consumption stocks, simply because I think there may be pockets of safety, because people have found it prudent to just keep adding and not selling. But I think the absolute returns will come from a completely different set of stocks in the market.
Okay. Earlier on in one of our conversations, you had alluded to liking pharma as a pocket. Do you still like that space?
I like that as a pocket because the Indian generic story is now becoming extremely visible and vibrant as far as US is concerned, which is the biggest market in the world. So the Indian pharma story has virtually nothing to do, the Indian pharma companies rather, have virtually nothing to do with, anything to do with the economy here, but actually to do with a preeminent position that they're carving out for themselves in the generic space in the US. Today, the number 2 generic pharma company in the US is an Indian company, and post an acquisition that it's about to make, that is about to complete, it will become the number 1 player. And given the kind of growth that some of the leading pharma companies have seen in the generic space in the US markets, which still remains the biggest market in the world, along with a stabilization of prices there, and some kind of shortages in certain segments, I think you're talking about very, very good industry which has been derated in recent times and has done nothing. And on historical basis is actually quoting at probably its lowest multiples it's ever seen. So from that point of view, I think it's a great space, but it's got nothing to do with the Indian economy, or for that matter, anything to do with as a fallout of the elections.
Do you think, you highlighted PSU banks, do you think its checkered past is going to come back to haunt, or do you think that some measures, some privatization, consolidation within the PSU banking space, if the government takes that as its priority and starts working towards it, is going to be the big next opportunity?
Four aspects of the PSU bank space that need mention. One, consolidation is already underway, and the example of the first consolidation of 3 banks, I think, has been a pretty healthy one. Two, it's come in the backdrop of an aggressive provisioning environment where NPAs have been recognized and written off. Three, the IBC, though slow in the beginning, but I think it's now working its way to actually creating resolution situations. And as non-performing assets get recognized and the balance sheet gets converted to a productive one with redeployment of money, with better risk management, and more importantly with consolidation, I think you're talking about substantial, and I underline the word substantial, change in fortunes for some of the leading PSU banks over the next few years. I think the numbers that they will produce over, let's say, 2019, 20, and 21 will be dramatic, to say the least, compared to, and add very healthy dollops of earnings to the Nifty basket or the index over the next 2-3 years. So I think the big turnaround is going to be in the PSU bank space, already visible. So it's not like I'm disclosing a state secret, but I think that's very visible. Consolidation is very much underway, and I think it will continue. To my mind, a lot of the resolutions have been addressed, taken through the books, and moved on.
How much importance are you giving to global factors affecting the perception of risk within the Indian equity markets?
Well, perception of risk is because I don't think the market at an optical level is trading cheap at all. That's because people have been increasing or decreasing exposures through principally the very, very liquid stocks, which is the ETF money coming in and going out. And that's, in a sense, keeping index levels pretty elevated. But having said that, I think if there's going to be a redistribution of the load being carried by index stocks, and some of the leading PSU banks and maybe a couple of infrastructure companies take the lead, maybe that can happen. I think I wouldn't rule out the possibility of a strengthening rupee as well. So maybe IT is a little under pressure. Pharma has not contributed much in any case, but the load could very well be taken up by infrastructure and PSU banks, just to name 2 sectors in the index. So I think from an index perspective, it's not that we're going to have a runaway market, nothing like the 30% in year 1 of the previous 5-year term of this government. But I think you will have reasonable returns, because I think whichever metric we use, the Indian markets continue to attract overseas, whether it's FDI or FII money, because we've just outperformed every emerging market country there is, both in terms of the last few years and in terms of continue to be an opportunity, because growth, even at its most pessimistic, is 6% plus. And clearly, I think this government is determined to reach higher levels and get back to the 8% kind of numbers, for whatever it takes to get there. But one thing is very clear, that we will continue to be a destination now, given this political mandate, in addition to whatever else our economic realities were. We continue to be 6% plus on the GDP. So I think we will continue to get money. Maybe the composition of the move may change, and the index may be a lot less up or down, but I think the broader market will move up. That's the way I see it.
Even now that we've all spoken a lot about what the foreign institutional investor brings to the table, what's actually keeping the domestic institutional investor at bay? Of late, you've not really seen them participating a whole lot much. Does that change now that there's more clarity?
I think it will change. I think you'll start getting domestic flows on the right side once again. and a lot of that money, which actually was essentially bleeding because the broad market was significantly eroded compared to the index. I think people's portfolios were hurting, and I think there's renewed hope. New money will come in, and to some extent money flow into smaller stocks will start having a salutary impact on portfolios, which in turn will drive more money to come in. So this is that vicious cycle of should I say, I would not say exuberance, but the feel-good factor coming through. So I think the confidence plus, as I said, money flow will be a combination. Of course, the fact that SEBI had categorized the top 100 stocks as large cap and the next 150 as mid caps, some of these may need to change, because ultimately, mutual fund managers need to determine where they put money in, not 85% in the top 250 stocks alone.
All right. Jix, just the last two questions from my end. How is the deals pipeline looking like currently on ground? I mean, you're in the midst of it, you're in the thick of things. Are you seeing a lot of openness in terms of deals happening in an easier way, or there's a lot of struggle to make sure you put deals through?
Well, this is the question that will get a permanent smile on my face, because that's the part of the business we are in. And one can speak ad nauseum about this, but the reality is the deal pipeline is strong. Interest levels are very high, and work, whether on the restructuring front or raising equity or raising debt, has never been stronger.
Okay. And lastly, you've spoken about a lot of themes that you think will do well in the upcoming near term as well as the long term, but one conviction idea that you have, or one thing that an investor should watch out for, maybe not a stock, but something that looks attractive enough for you to put a finger and say, okay, this could be a big wealth generator?
I don't want to actually, I think it's going to be, let me tell you one thing. I think the general environment of broader market moving is a good thing, but I think stock picking is going to become more and more difficult, because discrete events affect companies a lot more than ever before. Consolidation, to my mind, is a very, very big theme. So if one of the things that you're looking at is good businesses that are small, chances are that big kickers in terms of value will come through with consolidation. And I think one of the things that we are also seeing is consolidation is happening because of stress. That stressed companies are forced to sell out or consolidate, but it could also happen that the environment becomes buoyant, and whether it's in affordable housing, whether it's in infrastructure, all these spaces offer great opportunities for consolidation.
So look out for consolidation plays. All right. Thank you so very much, Jix, for joining in on this special discussion. Appreciate you removing the time.
Thank you.
And thanks a lot to our viewers.
As the vote count commences and the markets gyrate to every single vote, won or lost, Bloomberg